Good afternoon, everybody. It's 1 o'clock on May 22nd. Welcome to the weekly roundup for the Hart Investment Group. Appreciate everyone taking the time to listen today. I want to give you an update on what's going on in the world, how I see things, any changes in the views to the world. But I will be by myself today, so I will give you an update, chat, throw you some have you take a look at some slides and what I see happening today. So the week this week has primarily been focused around the potential tax bill, potential tax changes in the U.S., as well as the downgrade from the U.S. government rating agency. So Moody's decided to downgrade the U.S. government bonds. And so, I think big picture from it, it doesn't matter. It doesn't have an impact on the U.S. government's ability to print treasuries or make dollars. So I don't think there's a real default risk that maybe is something that we would have seen in the past. Some fear that we would have a risk of a default, and that's been the case. But what's resulted of this has been quite a bit of volatility in the U.S. Treasury market, where we had long bonds, the 20-year and the 30-year in the U.S. get up to that 5% number, and that 5% number is very relevant and very concerning for the economy as you start to see those rates move up. One of the big reasons why that's the case is in the U.S., your housing market is based off of the long bond. And so when you're looking at buying a house in the U.S. and again putting a mortgage in, it's the long bond rate plus a certain variable. So as that number starts to move up and over 5%, that really has a negative impact on the U.S. housing market and in turn the U.S. consumer, which is a major driver for the U.S. economy. And so that's been a major factor that we've been watching. And that's resulted in significant amount of volatility around treasury markets and equity markets as well. So we saw a reasonable correction into the equity markets yesterday and the previous day. And so right now we are looking pretty flat here. The NASDAQ and the S&P are relatively flat. Canadian market's down a little bit as well. And overall, I think the market's trying to digest what this means. In Canada, we had an inflation print come out, so we saw that inflation number. And so we've had lots of conversations with clients just around what's going on with the Bank of Canada. Are they going to continue to cut rates? Is the inflation number something we need to worry about? What's happening to the housing market? What's happening to the job market? And so there is a lot of cross currents, a lot of mixed information out there. Our view continues to be the case that we see rates come down in Canada and in the US as well. But certainly from a Canadian perspective, we see the Bank of Canada right now, something in the neighborhood of 75 to 80% likely of a rate cut in June. We'll see if that number changes next week with new data that comes out. But that's still where we see the view is that rates come down. We saw inflation a little bit lighter in April than expected. But on the flip side of that, we saw core inflation, which is also what the Bank of Canada looks at, a little bit higher than expected. So a lot of mixed data coming out from an inflation and economic perspective. So we still think rates come down in both countries. So that I'd say is the quick update on what's been happening in the markets and what's been happening from an interest rate perspective here. So I'd say maybe we can jump into the charts here, give you my comments and thoughts just around that, and then can elaborate and just summarize what actions, if any, have taken this week as well. Okay, so we are recording this, as I said, May 22nd around 1 o'clock. So anything that happens between now and the end of the day tomorrow certainly will provide context and updates in the next roundup next week. So I thought I'd take a slightly different tack this week and just maybe comment on a couple of the daily charts that I put out. And sometimes I put obviously a tagline headline to think about, but maybe a reasonable elaboration might be worth thinking about. And so if you look at maybe a couple of weeks ago, I talked about money supply, particularly with China and Japan, just on around the fact that their M2 or their money supply has not been increasing versus the rest of the world. So when I saw this chart pop up, I thought this was an interesting one. So if you look at this top chart, it says China, longest deflationary streak on record. So it's interesting and relevant. And if they continue along this path, they're going to continue to see some unrest start to kick up in China. So they're in a position now where they can start to look at really putting their foot on the gas, as I mentioned. So seeming to run out of ideas on how to break out of the slump. I mean, I think there's a lot of things that they haven't done yet. And I'd say the probability of further liquidity into the Chinese market and economy continues to be quite high. And so if they decide to do that, I think we could start to see a really material pickup in money supply globally, obviously with China being a big contributor to global economy. The next part would be related to Canada. And so I have a lot of questions about the Canadian housing market, which most people that I speak with are interested. What's going on with rates? What's going on with housing? So uncertainty had uncertainty had an impact on housing in April. So if we look at this, Quebec all the way down to Ontario here, so Ontario, BC, Alberta, which had probably grown the most, have had the most slowdown since then. So rates continue to play a part here where the fixed rates have been pretty flat sideways year to date, where that variable number has been coming down as Bank of Canada has been coming down. Hasn't come down as much as the Bank of Canada has. However, this will be an important piece to watch and also play a part into what happens to our country and economy as well. So the question that I get is just what's happening with the economy. And so this is our most updated data to look at what's our forecast for GDP. And so advanced economies versus emerging economies, real great way to look at it. So US in 2025 expected to grow still at 1.5% is our view. Eurozone 0.8, Japan 0.9, UK 0.9, Canada down as well, 1.1. And so all of these numbers, I guess, if you look at them, are growing plus or minus 1%, which isn't certainly robust growth. But one thing I think that's relevant to pay attention to is just the rate of change of these numbers. GDP last year in the US was 2.8, we'd go down to 1.5. That's a slowing economy versus a Japan at 0.2 into a 0.9. So you've seen the Japanese market economy accelerating. So in turn, you've seen stock prices front run and lead that. And so we'll see what happens from now, but that's an interesting takeaway. From a Canada point of view, 1.5 to 1.1, again, slowing economic activity. So the Bank of Canada started cutting rates a year and change ago. And so they foresaw that we would see a slowing economy, inflation coming in. So they started to cut into the face of that. As a result, I think the contraction right now likely will be slower than initially impacted or expected. So the tariff piece continues to be a major part that we'll have to watch, but this is a reasonable view to look at this. And then if we look at the emerging economies, as I point out, those countries are growing quite a bit faster. But then when we look at China, that was the point I talked about before. India continues to grow quite quick. But Mexico, I mean, the Mexican economy did okay last year, but Mexican stocks really struggled. And so if you look at forward looking, you'd say, okay, maybe Mexican stocks have bottomed now. Maybe there's an opportunity there. So I think it's a great way to look at the economy globally. Lots of questions around what happens now. But as these numbers continue to slow, the likelihood of more stimulus coming into the global economy continues to be quite relevant. Last piece before I go into summary, just talk about positioning and what I think should happen over the next couple of weeks. This jumped out at me. Lots of questions. I think the biggest thing and reason why this jumped out at me is I've started to see some stores close. We've seen a couple of Sobeys stores close in Ottawa the last little while, and so I thought it'd be worthwhile to take a look at some of the different REITs that have exposure to some of the stores in this place. And so when we look at Crombie, for example, Crombie is 100% grocery anchored, of course. So 59% Empire would be Sobeys. So it's worthwhile looking at some of these concentrated risks versus some of the other diversified retail REITs. So Canadian CT REIT, obviously their anchor tenant would be Canadian Tire. So 92% of the CT REIT is Canadian Tire. So that is similar with choice properties, which would be Loblaws, of course. And then if we look at the more diversified, say RioCan or maybe a Primaris, RioCan has about 18% in its top 5 tenants. So, excuse me, more of a diversified retailer. And so if you look at the breakdown there, that'd be, yeah, TJ Maxx, Canadian Tire, Loblaw, Shoppers, Metro, Cineplex are the anchors there. So yeah, I think it's interesting if your view is that rates kind of go sideways to down and you think that the Canadian economy does okay. These offer reasonable risk rewards, certainly as you see the target prices and the yields they provide. It's worth looking under the hood though and saying, what is my risk and what is my exposure? But these are examples from the retail REITs that are worth paying attention to. As always, the opinions expressed in here do not necessarily reflect those of MBF. I prepared this report with the best of my professional experience and knowledge. If you do have any questions, certainly please consult myself or your advisor, and happy to elaborate on those discussions at that point. So that's the slides of the day today. I think big picture as we start to approach the middle of the year here, May's turned out to be a pretty good month from a market perspective as they go through portfolios returns. All portfolios have bounced back and snapped back quite well. As I may have mentioned, I had bought some additional exposure into the sell-off in April and have now sold that as of last week, and so reduced some equity exposure. Yeah, I think generally we still see money supply start to come in. We see rates come down, but there continues to be a lot of moving parts from a tariff, trade, war happening in the world. And so I'd continue to monitor that quite closely as the markets bounce. I start to say, okay, are we starting to see a material change in economic activity, or was this just a bounce in markets because of the size of the correction that we saw in April? So, typically when we see volatility like we're seeing now, that gives you some signs to be cautious. And so I added some risk in April, took some off in May, and we'll assess what to do from this point. So as we approach the end of the month next week, I'd be looking to see ahead and say, what do we do now? What does the market want to go? Where does the market want to go from here? Volumes have certainly been slower this week, and Monday is a US holiday. And so we're likely to have a little bit less volume next week again as well. And then the US Treasury market will be a key thing to watch. The tax bill that's being discussed as well will continue to be something to watch. And so my focus would be on let's see what happens with liquidity. Let's see what happens with the US Treasury market over the next little while as it starts to digest the potential tax changes as well as a debt ceiling that we're going to have to deal with next month too. So those would be the key focuses. Let's one day at a time, but nice bounce back in May. And now I'm assessing how and if we should proceed more cautiously or take a little bit more risk. So one day at a time. As always, I appreciate you spending the time today, listening to what we have to say. If you need anything, please reach out to myself or Eva. We're happy to have a call, conversation, give you a specific view on your portfolio. But thanks so much as well. Enjoy the weekend and look forward to seeing you all again soon. Take care.